All right, everyone. Hello, good evening. Thank you so much for being with us this evening. My name is Xavier Duran. I am the Adult Programming Coordinator for the Lisle Library District. A couple of things before we begin. This is what's called webinar format, which means only myself and the presenter have access to a microphone and camera. That means that you'll be able to hear us and see us. I will mute my cameras and my sound soon. But that means we won't be able to hear or see you, which is good if you're still in the middle of dinner. Um, so you're more than welcome to just relax and listen to us as our presenter delivers. But that means that we won't be able to hear you. So if you have any questions during the program, please put that in the chat or the Q&A feature, and I will go ahead and relay that to Dr. Jim Flanagan. With that said, I'll go ahead and hand it over to Dr. Jim Flanagan.
Thank you, Xavier. And thank you all for attending tonight. I think Xavier brings up a good point. This is the only time in human history that you can go into the library now virtually with food and drink and spread out, enjoy your meal while you're engaging in library activity. So it is a brave new world. Thank you for stopping and taking time tonight to learn a little bit about the Social Security program. And Social Security is a massive government program that's been around for a long time, and it's a central part of the work that I do as a retirement planner and a financial gerontologist. So my background is in retirement planning. I'm a registered financial consultant, a certified estate planner. I have a master's degree in finance from Dominican University, a master's in gerontology from the University of Southern California, and a PhD from Concordia University in River Forest, Chicago. I've been doing this work for a little over 30 years, and tonight I'm going to share with you the things that I've learned about Social Security, try to really explain to you what the program is, how it works, and I'll get to that in just a second with respect to our agenda. First and foremost, I want to make it clear that when we're talking in educational terms. We're not making any specific recommendations to any individual, personal or otherwise. It's important that you always consult your own advisor, your own professionals that you trust that help you with these matters to determine if any type of change is necessary or needed. So I gave you a little bit of background on myself. This is what I look like without a blurred screen behind me. I work with a company that I started about 25 years ago called Bentron Financial Group. We're a financial and estate planning wealth management firm. We try to do things in a simple, straightforward way. Education's at the heart of what we do, and hope to try to really do things in a unique way, and so unique that I have a patent on what is called purpose-driven planning, where I developed a process that's unique to our planning process that helps people achieve their own individual plans and goals in a way that is documented to be successful. So that's what we are, and what we try to do is help people with investments, provide estate and financial planning advice. I'm considered a Social Security Medicare expert. I didn't mention that I've taught at Concordia University, River Forest in the social sciences gerontology department. I'm an adjunct professor currently at Triton College in River Grove, where I teach the retirement planning curriculum. So we provide other types of services related to aging. More than anything, that's a lot of what I do, is study the biological, psychological, social, and environmental processes of aging. So tonight's presentation is going to focus solely on Social Security, and we're going to take a deep dive into the program, talk about how it's changed, what benefits look like today, how they're calculated, how benefits are calculated, how they're taxed, how they work for widows, how they work for divorced people, And along the way, please, if you have any questions at all, don't hesitate to ask as we go. I think it makes for a much more fruitful conversation. So Social Security, excuse me, is one of the largest government programs that's ever been in existence. It was signed into law in 1935 by Franklin Roosevelt. And important to note that at that time, there were far more people paying in to the program than there were receiving benefits. So at the same time, too, I think it's important to note that at the time the program was started, retirement age was 65, and life expectancy in 1935 was 63. So they didn't expect a lot of people to collect Social Security. It was truly a safety net program for much older adults, much more long-lived people. So the first person to ever receive a monthly check was Ida Mae Fuller, and she received a benefit in 1940 in the amount of $22.54 at the age of 65. So she had already beat the actuarial odds of life expectancy. And if anybody would want to venture a guess to say, well, how long did Ida live? And because I can't see you or hear from you, the answer is simple. She lived to be age 100. And so if I was an actuary that did some of the formulations to determine the fact that Ida probably shouldn't have lived till 70 and she went and lived till 100, the first beneficiary that collected, I probably would make adjustments to the system, but nothing like that has ever been done. So life expectancy has increased dramatically. Benefits are more than they were before. A lot has changed. There's one thing that hasn't changed, and that's attempts at fraud and abuse. And this is something that's been consistent with the program since its inception. One of the earliest examples of this was a secretary. I believe her name was Irma Wechter, and she was a secretary for a wallet manufacturer in New York. And her boss came to her one day and asked for her Social Security card so that they could put it in a wallet to show how neatly it fit in that clear plastic opening. Well, they used a photocopy of her Social Security card and then distributed it in hundreds and hundreds of thousands of wallets nationally. And to this day, more than 40,000 people have claimed under her number 078051120. In 1974, there were still 12 people claiming on that number. So abuse is rampant in the system. You'd think they could just go and find the people. If they send them checks and they cash it, how come you can't find them? I don't know, but that's the government, and they're here to help. So when the program started in 1935, life expectancy 65. It's only for retirement. There are no other benefits, no benefits for widows, divorced, children, and certainly no disability benefit. There are a lot more people paying in rather than taking money out. As a matter of fact, if you look at these numbers, the payroll tax rate then was 2%. Today, what are we looking at? 82 years later, it's only increased by 10%. The earnings cap, people talk about this all the time, as something that should be increased, that should go up. Excuse me, this is a telling number here, because if you look at the number of beneficiaries in 1940, 222,000. Today, almost 94 million. That's a stark difference. And at the time, you had 159 people paying in for one person receiving benefits. And today, there's 3 people paying in for every one person receiving benefits. People don't realize that the money that's deducted from our paychecks this week and this month will be used to fund the payments that go out in Social Security next month that our parents and grandparents receive. And so it's a system without reserves. It was set up that way by Congress. So when it's had surpluses in the past, different presidents, different parties have used that money for different things. It's not a political thing. It's what they always do. So during the Clinton era, there were great surpluses, and they took that money out. They paid down the deficit. And they ran surpluses on the budget. Again, a lot has changed since then, but somebody should have thought, hey, we might need more money when all these baby boomers get there, that we do need a reserve. And that the reason there's a surplus is because we have all these people paying in now that weren't around in 1940. They were, in diapers, they were going to grade school, doing that kind of stuff. So the average retiree benefit in 1940 is $22. Today, $16.57 a month. That's probably a little old right now. The question that everybody needs to ask themselves really is, where does Social Security fit into your picture? Are you going to get a pension from somewhere? Will you get an inheritance? Will you save up a whole bunch of additional money? How will you piece together this retirement? And it's different for everybody based on the type of work that they do and the experience that they have in their life. But the question really is how important is this conversation? Is this really something that we should be concerned with? And if you look at these numbers, I think it bears the reason that it is. Because right now, the maximum benefit for a high earner in 2022 is about $50,000 per year. Okay. So if you came to me and said, I want an extra $4,000 a month or $50,000 a year, how much money would I have to give you in order for you to invest it and give me a guarantee? Remember, this is guaranteed lifetime income that you can't outlive and that will go up with inflation. And that's one calculation that no one can ever do when they talk about drawing Social Security early, which we say is a big mistake for most people. So the bottom line is, if you got a 6% rate of return or a 5% rate of return, on 600,000, you'd only be looking at $30,000. So a 10% rate of return on 600,000 would be $60,000 a year. So this is probably somewhere between $500,000 and $1 million, the decision that you make when you actually take it. And I think the important thing is that we all make sure that we have income for as long as we are alive, and that we can guarantee income for anybody that's dependent on us if we do die prematurely. That's the goal of this whole exercise. So I say it's not inconsequential. It is very important. These do adjust for inflation. They're benefits that last a lifetime, and they can last that of a spouse's lifetime as well. So when you consider that calculation I just did a minute ago, for two spouses, you could be talking about a $2 million decision, almost $100,000 a year in income from two high earners, both collecting benefits on their own record, and both incomes coming in at that level for as long as both spouses are alive. Thing to remember is, for married couples or people in same-sex marriages, but in married relationships, benefits cease for the lower payment upon the first death. And I'll talk about that more in a minute, but you want to shoot for one check, you want to shoot for the high number. Okay. So how do you determine your benefit? Benefits are determined, you're actually saving for retirement from the day that you start working. I'll never forget when my son started working at he tutored for the Learning League in Oak Park, and came home with his first paycheck, and he was supposed to get $10 an hour, I think, and he worked 10 hours. He was expecting $100, and he comes home and he asks me, "Who's FICA?" Well, it was the FICA, which is the withholding tax, and so he saw these things on there that he just was not aware of. That and he was like, "You mean they take your money when you get paid, and then when you go to spend your money at the store, they charge you more taxes there?" I said, "Yes, son, that's exactly how this works." So we've been saving since the day we got our first paycheck. The 35 highest years of earnings are what are going to be used to calculate your benefit. So people will ask me if they had a high earning job and then they're going to stay on and work another year as a consultant, maybe make a little bit less, that they're going to do, well, does that lower my payment? The answer is no. It'll probably knock out that year you were in high school tutoring for the Learning League. 35 highest years of earnings are what are used. Those years are calculated by quarters or credits. You get 4 credits per year. So you technically have to work 10 years to qualify for Social Security and earn $1,500 in each quarter for 10 years, a minimum. And then so for that person, if they only worked that 10 years, they would qualify. They would have 25 zeros. 10 of those, the numbers that they earned, and that would be how their benefit is calculated. It's not a simple calculation either. What is done is the benefit is adjusted each year for inflation using the base inflation rate for the year, and it's calculated moving forward for each year for each benefit. And then it's put into a logarithm to determine what the actual benefit itself is. So it's not a straightforward mathematical calculation that I could share with you. So where do we get this information? Today, everything's online, and the best place for you to start thinking about Social Security and Social Security benefits is online. And the reason I say this is because the paper statements were discontinued back during the financial crisis in 2008, 2009, cost Social Security about $20 million a year just to mail statements. So they discontinued the statements for people under the age of 60. All the information can be found online at ssa.gov, all right, or socialsecurity.gov/my statement, the web address that you see below on this slide. It's a good idea to go there to check your benefits to make sure that your numbers have been entered properly. You don't want to have an issue with an improperly reported year of earnings after you've made the decision to retire, and then you realize that for 3 years they had transposed a number. I've seen strange things happen when people look at those statements. They're usually pretty accurate, but I've had enough happen over the years that it's really worth looking at. So a lot of people are eager to get benefits. People are, sometimes people are worried about the solvency of Social Security. The number that's being thrown around right now is 2035. In 2035, what's going to happen is the amount of payments going out are going to be equal to the amount of money coming in. Exactly. There won't be any of the surplus. There won't be any. So they're at that point, they're going to have to legislate additional funding to keep the payment level where it's at. There are some simple things that could be done. We could change the age from 67 to 68, take away that earnings cap, and increase the payroll tax rate 2%. And you could solve solvency for 100 years. And why politicians don't do it, I don't know. But I think if they knew how simple it was, they could probably get reelected if they were interested. But you can collect benefits as early as 62. I will tell you that If you do, benefits are reduced by 25%. When I was doing research for my PhD, I spent a great deal of time working on some Social Security questions through the Boston Retirement Research Institute. And Social Security came out in a white paper and said that the biggest disservice that they have done to the American people was communicate to them that they could take benefits early, because it's adversely impacted people of lower socioeconomic status, lower levels of education, and lower levels of income. Those people would have benefited more by waiting than from taking the benefit early. So you got to think long and hard about when to take this and how to take it. One of the things that we'll do, and I'll do for anybody on this call, if you go online and get your statement and email me your statement, I'll produce a complete calculation of the different benefit options for you and a spouse, or you and a partner. We do this free of charge. I think it's a powerful tool to have. It's the basis by which we start a lot of the income planning that you're going to do when you start thinking about, how am I going to patch together the income that I need in retirement? Some people need $5,000 a month. Some people need $50,000 a month. So how are you going to piece together your $50,000 a month if that's your, if that's your lifestyle? So most people are going to collect at age 67 if you're born after 1960. But I'm going to show you how they have the table for that. It's the next slide. So we'll look at that. But benefits are reduced if you collect at 62. So here's what we call the FRA, or full retirement age. This is the year in which you collect your retirement benefit. You still will collect your Social Security promise of Medicare at the first day of the month in which you turn 65. So there's two promises that were made to us under Medicare. One is that of a retirement benefit. That's what we're talking about tonight. The other is that of a benefit for healthcare, and that Medicare age 65 has not changed. So that's still the age in which you get Medicare. You may or may not need it or use it because you might still be working, you have employer coverage. That's a different presentation called healthcare and retirement. So these are the full retirement ages for the various years of birth and ages. So we say 67 is the new 65 when we think about full retirement age. 70 is the latest age at which you can collect benefits to maximize them. Okay, so it doesn't pay to wait past age 70, but that's how you will achieve the highest benefit. And I'll show you what I'm talking about. So what this chart shows is the fact that if you retired 4 years early, you see the gold bar there, $750 a month. Baseline full retirement age being the blue line, $1,000 a month. If you wait just 3 more years, okay, so yeah, you're going to forego $100,000 of income. But if you waited 3 more years, you would increase your benefit by 32%. Okay. So I think what's important there is then that your future cost of living increases and all the future increases that you're going to get are going to be based off that 1320 number, the highest number. And that's the age 70 number. So in most families, we want to get one person to age 70, one person thinking about that biggest check that we can get. So, I've talked a little bit about gerontology being the study of, biological, psychological, social, and environmental processes of aging. And I cannot say to you how important it is for us to think about longevity, to think about our future healthcare costs, to think about long-term care, to think about what aging means in a modern world. I think what used to kill us in the good old days doesn't kill us anymore. People used to die prior to I would say prior to 1900, it was what we call pestilence and famine. And then maybe it was prior to 1820, something like that, pestilence and famine. Then it was biologics, and that was cured when we dug the Panama Canal and came up with penicillin and all the biological remedies that we have today, like the vaccine for COVID-19. What kills people today are chronic conditions and diseases for which there are no cure. Cancer, heart disease, diabetes, hypertension, high cholesterol, dementia, Parkinson's disease. And in the forms of dementia, there are a dozen different forms of individualized dementia or cognitive decline. Mild cognitive impairment is present in 50% of the population over the age of 80. So if people never lived to age 80, that's why we didn't see these things before. I've been doing this work for 35 years. I know I look too young to be doing this for that long, but it's true. I started in the business at a young age, right out of college, and have never looked back. And at the time that I started, I didn't know anybody in the people that I served that had cognitive impairment. Today, I work with maybe 15 or 20 different families where cognitive impairment and some form of dementia is at play in the relationship that we have. Aging is different. They're going to continue to have advances that are going to cause us to live longer. Retirements are longer. They cost more. And no one wants to work past 62, 65, 67. And, I understand. I understand all that. There's been a lot of research that's done about the psychological process of how people do process their need for retirement or their need to get out of their profession. 35 years in, I'm not looking to get out yet. I'm very happy doing what I do. I feel like purpose and meaning is at the heart of what we all need to do to find our place, and that can come in the form of serving family, community, work, volunteerism, gardening, whatever your passion is. So this is kind of like the really one of the key takeaways is, why would I wait? Because one of the things that I read about and write about all the time is the biggest fear that people have is running out of money. It's outliving money. So how do you hitch your wagon to the star that's going to get you the biggest paycheck for the longest guaranteed period? There's only three things that'll do it: a pension, Social Security, or an annuity. There's only three things that'll guarantee income like that. So we talk about filing late, but when would it make sense to file early? Well, what if somebody didn't have long life expectancy and had multiple comorbidities, a lot of different health conditions? They might consider filing early. What if you had a financial shock? COVID-19 comes along, your company closes, and you're forced to retire. What if you were retired and waiting, but we end up with 30% inflation and you need more money? What if children came back home? Some changes took place in your life. Those things might, be cases for filing early. So spouses are entitled to a benefit whether they have worked outside the home or not. And that benefit is equal to 50% of the primary earner. All right. Got to be 62 or older to qualify. And they're always able to collect a benefit on the spouse's benefit, including the Medicare healthcare benefit. All right. And it's really important that, people know that spouses are included in this package. They get a separate payment. But if I get a payment, say I was the high earner, and we want to wait for my payment to get to that, $50,000 a year, and my spouse's payment's never going to be more than $25,000 a year. So if I die prematurely, she's going to get the 50. If we both live a long time, we get the 25 and the 50 for as long as both of us live, but we're going to lose that 25 at some point. When you think about that, that's $2,000 a month. If a family budget was $6,000 a month, that's 30% of the family budget that's lost with the death of the first spouse. And then statistically, if you look at things the way that I do, if a family's, a couple 62 and they come to see me, there's a 92% chance that one of them is still going to be coming for assistance 30 years later. And that's a strong statistical presence. So something to consider. So survivor's benefits, you could file as early as age 60 if a spouse dies. Okay. But the benefits reduced, and you have to be you have to be in a position where you can't claim a higher benefit on your own record. Okay. So if the person remarries, then they also are not eligible for the survivor benefit, or they would get the survivor benefit until they remarried, then they would lose it. Sometimes this is why people at older ages don't marry, so they can maintain their Social Security benefits that they have. I mentioned earlier, same-sex marriages are approved. Different states are trying to implement the process of how to implement payments, but there are payments for same-sex marriages. Now, there are benefits for people that are divorced as well, and divorced benefits for a divorced spouse do not affect the benefits of the ex-spouse or a new spouse. So you could be divorced twice and have two spouses claiming, and neither's benefit would be reduced, nor would the primary earner's benefit would be reduced. But each of those marriages would have had to last 10 years. You have to be divorced for at least 2. The former ex-spouse has to be entitled to benefits. That means age 62 or older, unmarried, which means it was a bad situation probably, and cannot qualify for a higher benefit on their own record. So there's a handful of conditions in there, but there's a safety net then for people that get divorced, where they can always go and claim. So they don't have to talk to the spouse. You go to Social Security, they know you were married. They have the records. They have the record on the ex-spouse, so they can help you determine the appropriate filing strategy in order to implement a situation like that. I think at the end of the day, that's really what this is all about. It's getting the right filing strategy for your family, knowing when to claim for a spouse and when to claim for that primary earner. That's what that report does, that I can do the calculations and show you. Here's the difference, and here's the difference over this time period. So if it's inconsequential, you don't wait, you take the money. But if it is consequential, then it tells you really what to do and why. And again, I think that's important. So what about if you're 62, and I don't know why you would do this, but if you were working, you're 62 and working, you're paying your bills, and you take Social Security, what happens? And the effect is not good. What happens is your benefit is reduced $1 or 50% for every dollar you earn above $19,560. So if you were making $40,000 or $50,000 a year at your job and you took your benefit, you would be taxed on the full amount of the benefit, and it would be reduced by 50%. So you're going to lose 60 to 70% of the benefit, and you're still working. So I don't understand why you wouldn't wait. The payment will just continue to ratchet up. And that's really what probably is in your best interest, rather than, people like, well, I socked away the $642 a month for 3 years. Yeah, but look at the effect that you had. And now you've locked yourself in to that lower payment. So important to understand, once you make a decision, once you claim, you cannot undo it. You have one chance in your life. Let's say you claimed because of an illness or a job loss or something. 6 months later, you're back at work, and now you're like, I don't want my Social Security. You can get out of it, but it has to be within 12 months, and you have to pay every penny back. So some people, if you had to take the money, you might not be in a position to pay all that money back. And that's really, truly what you have to consider. So working and receiving benefits. Now, as soon as you get to your full retirement age, this age 67, you can work and earn an unlimited amount of money, and there's no reduction in benefit. Okay. So if in your family, the solution was one spouse was going to wait, the other spouse was going to take it 67, and they were still working, then you know, you're just going to collect that benefit. Then it makes sense to bank it. So I got a question here. If a lower wage earning spouse who wants to file earlier than the higher wage earner, then can they later claim under the higher wage earner once the higher wage earner does file? Karen, too complicated a question to answer in this forum. Some of the file and suspend strategy, if you claim on your own benefit, you're going to be locked in. If you claimed on, you can claim on a spousal benefit and then later claim on your own, but I don't believe you could do it the opposite way. The system that we use to calculate this would actually answer that question. Thank you. So what about taxes in Social Security? First of all, the promise was made that Social Security benefits would never be taxed. It lasted 1 year. And then they passed a law to tax it. So your wages are taxed throughout your earning years. So your Social Security benefits are going to be taxed throughout your retirement years. So that means that you're going to pay taxes on your benefit at an ordinary income tax rate subject to certain limits. Okay, and I'm going to show you what those are. But before I get to there, I got to tell you how they came up with what we call provisional income. And provisional income is the calculation that they use to determine what a person that's receiving Social Security's total income is. And what is interesting about this calculation is, if you've ever heard the term, everything in the kitchen sink, this is what they did to retirees. They took provisional income and said it's the sum of all income from wages, pensions, investments, interest and dividend income, any other exclusions to income, any non-reportable income, and half of your Social Security benefits equals your provisional income. So then we're going to use that total number and apply this table here for taxes. So if you're married and earn less than $32,000, that calculation, which would mean half your Social Security and all those other things added up are less than $32,000, then you will pay no tax on the Social Security. Between 32 and 44, tax on 50% of the benefit, not a 50% tax, 50% of the benefit. So if you're in the 10% tax bracket, you got $20,000, you'd pay $1,000 of tax, is what would you be looking at. Greater than 44,000. So here's my wish for everybody here tonight that's attending, that we're all paying taxes on 85% of the benefit we receive. That means that we will all have at least, if we're a single filer, at least a $3,000 a month income. And if we're a married couple or a joint filer, that we're making more than $44,000 a year. Taxes are taxes, and obviously they're going up. We all have to pay our fair share. how we pay them and how we go about paying them is important, but I don't want to live in poverty to avoid paying taxes. Okay. Had a family long, it was a family member's uncle. He wasn't my uncle because he was a rich uncle. And he and his brother lived together in a house downstate, worked in an auto body assembly plant. They were the guys that would put the can of soup on the pilot light on the stove, and the soup can would be warm when they got home, so they didn't have to turn on the stove. They never spent a penny of the money they earned. So, and they died, in a frugal way with millions of dollars stowed away that then the family went through in pretty short order. So I think about making sure that people have adequate income to live a lifestyle that they're accustomed to, a lifestyle that doesn't change with age. Sometimes it gets more expensive because we got to pay for things that we didn't have to pay for before. So really, I guess the key takeaway has got to be that you've got to really think long and hard about your filing strategy. Think long and hard about the process, about your own personal plan for producing a lifestyle sustaining income. How and when you do this in terms of when you're going to file for Medicare so that you maximize benefits. The question that Karen had about, spouses filing and suspending, that's the game that we play. But Social Security's done a good job in the last 3 years, 5 years really, of closing all these different filing strategy loopholes that we used to use. So the calculations speak the truth. Be more than happy to share that with you. I'd also be happy to share the Society of Actuaries has a website that they have what's called the Social Security Fix-It game. And you could Google it, but I've got the link. I could send it to anybody that emails me. That basically will walk you through the solvency of Social Security. It really makes me feel a lot more comfortable when I look at it and I see how simple it really is to fix the solvency issue that we have. So we've got another question. It says one's monthly benefit is estimated to increase 8% annually for each year receipt of the first benefit is deferred until 70. Does that apply regardless of whether or not you work while delaying the first benefit? So the answer to that question is no, it still increases the 8%, but will also increase for additional years paid and or additional income paid in. Do all cost of living increases granted before one receives Social Security benefits adjust the ultimate amount one will receive once on the program? Yes. So best example I could give you is, yeah, that's how they're adjusting forward. The inflation adjusted value of the money that we earned in 1989, in 1993, in 2010, and today. So as we're seeing more inflation today, that will be factored into the calculation. I had a client I've had for over 30 years. She's in her 90s now. When we started working together, her Social Security benefit was $864 a month. Today, it's over $2,300 a month just from cost of living over that 30-year period. So again, something to consider. Those benefits are not inconsequential. I've heard the break-even age for benefit deferral to age 70 is 78 or 79. Didn't receive prior to 70 equalized. No, that's not correct. The 13.3 years. Actuarially, the benefit break-even period is 13.3 years. And the calculations bear that out in a couple of different ways. Does it make sense for someone with advanced heart disease and only able to work part-time to take benefits at 62? They're currently 60. That's a good question. definitely something to consider. But what I would consider is the other resources that you have to influence that decision. If you take that, because as long as you're fighting the heart disease and you're working part-time and you're making ends meet, it's always going to be better to wait. At the moment you can't work anymore and you can't make ends meet, then you have to take it. But if you said, well, I have this other resource that's likely to sustain me, and my life expectancy is probably only 12 years, then you would take it. I do offer consultations to anybody. It could be Zoom, it could be in office. I have an office in Downers Grove, right at Butterfield and 53. I have an office in Oak Park as well. But happy to answer. These are they get to be personal questions, and it's really important that in a way that we get this part right. So great questions. Thank you. So, really that's at the heart of all of this is the decision-making process and trying to do it in a way that's measured and meaningful, and that comes from a place of being informed. So you make this decision by looking at where it fits into other retirement plan benefits that you might have, other investments, annuities, life insurance. SSA.gov is the source for all things Medicare, Social Security, and the like. Again, on this slide, you see my phone number, my email address below. Happy to assist anybody with any personal questions that they have. Sometimes it's hard in a forum like this to ask a question or to get some share personal information. So always happy to help people in that process as well. So that concludes the presentation. If there aren't any further questions, I appreciate your time and attention. I like to try to keep these presentations to under an hour, and I think we've accomplished that tonight. So looks like I've got one more thing in the chat. Thank you very much, and thank you all for your time and attention.